The Federal Reserve just pulled the trigger on one of the most significant rate cuts in years, a 0.5% slash that could mean we are already sliding into a deep recession. But what does this drastic move really mean for economy, the stock market, and most importantly, your money? Stick around us as we unpack Jerome Powell's latest statements, dissect the real reasons behind this aggressive policy shift, and reveal the hidden dangers that could impact us all. The Fed's recent rate cut is more than just a headline. It's a bold move that's turning heads across the financial world. While the cut might seem like a straightforward attempt to tame inflation and stabilize growth, there is a lot more going on beneath the surface. From a tumbling dollar to soaring gold prices, the market reactions are flashing warning signs that shouldn't be ignored. Today, we are breaking down the full impact of this rate cut, from the Federal Reserve's motivations to the broader economic implications that could affect your investments, your savings, and the future of economy. Let's start with what Fed Chair Jerome Powell had to say. During his press conference following the latest FOMC meeting, Powell announced the decision to cut the policy interest rate by 0.5% point, making one of the most aggressive rate adjustments we have seen in years. He emphasized that this recalibration is meant to maintain strength in the labor market while guiding inflation back down to the Fed's 2% target. But there is more to this story. Powell's tone and the specifics of his statements suggest a growing urgency, a signal that the Fed is bracing for tougher economic conditions ahead. He projected that if the economy evolves as expected, we could see the federal funds rate drop further, potentially reaching 4.4% by the end of this year and 3.4% by the end of 2025. This points to at least one more significant cut rate in the coming months and sets the stage for further reductions in the near future. Powell also touched on the inflation outlook, noting that patience in reducing the policy rate has finally paid off, allowing the Fed to feel confident that inflation is on a sustainable path towards its 2% goal. However, while inflation might be cooling, the same can't be said for the labor market. Powell acknowledged that labor market data might soon reveal significant changes, with a major revision expected to show an increase of nearly 990,000 jobs lost, a revision that would paint a far bleaker picture of the current employment situation. The Fed has already adjusted its unemployment forecast, now predicting a rise to 4.4% by the end of this year, up from current 4.2%. This may not sound like much, but consider that just a few months ago, the forecast was only 4%. This rapid shift underscores how quickly the economic landscape is changing, and it's not just about the numbers. The labor market is beginning to show cracks, with job growth slowing and new hiring lagging behind expectations. Powell specifically mentioned the impact of immigration on employment statistics, highlighting how an influx of new workers can distort traditional unemployment measures. This suggests that even the Fed is concerned about underlying weaknesses that aren't immediately visible in the headline data. But what happens if the labor market deteriorates faster than expected? Powell hinted that the Fed might have to react more swiftly with additional rate cuts, especially if job losses accelerate or if other economic indicators start flashing red. This is a precarious balancing act. Cutting rates too quickly could stoke future inflation, but moving too slowly risks deepening an economic downturn. If you are finding this breakdown valuable, don't forget to like this video and share it with your friends. Your support helps us reach more people who need to understand these crucial economic shifts. The financial markets have already started reacting to the Fed's latest move, and the signals are mixed. One of the most immediate effects was seen in the US dollar index, which fell to its lowest level of the year following the rate cut announcement. This drop reflects growing skepticism about the dollar's strength as investors begin to weigh the long-term impacts of a more dovish Federal Reserve policy. Gold, on the other hand, is having a moment. Spot gold prices surged to a record high of $2,560 per ounce as lower interest rates made gold cheaper for investors holding other currencies. Historically, gold is seen as a hedge against both inflation and economic uncertainty, and the current rally suggests that many investors are preparing for rocky times ahead. Meanwhile, Treasury yields are also on the rise, with the 10-year yield climbing 6 basis points to 3.7% and the 2-year yield moving up to 3.6%. This increase in yields signals long-term concerns about inflation despite the Fed's assurances that it's under control. Higher yields usually mean higher borrowing costs, which could further complicate the Fed's efforts to stimulate growth without overheating the economy. Put it all together and you have a scenario that some are calling a perfect economic storm. A falling dollar, rising gold prices, and increasing Treasury yields paint a picture of an economy that's caught between conflicting pressures. Powell may be optimistic about the Fed's path forward, but the market reaction suggests that investors are far less convinced. What's your take on all of this? Do you think the Fed is making the right moves, or are they setting us up for a bigger crisis down the road? Let me know your thoughts in the comments. I'd love to hear your perspectives. While the immediate goal of the rate cut is clear, bolster the economy and bring inflation down, the long-term implications are much murkier. Some analysts worry that by cutting rates too aggressively now, the Fed is essentially planting the seeds for a future inflationary cycle that could be even harder to control. In other words, today's solutions might be tomorrow's problems. The Fed's strategy hinges on maintaining price stability without causing a painful spike in unemployment. But that's easier said than done. If inflation reignites, the Fed could be forced back into a cycle of rate hikes, which would put even more strain on the economy and financial markets. This ongoing tug-of-war between growth and inflation control is one of the most challenging aspects of the Fed's current policy stance. With each rate cut, the Fed is trying to walk a tightrope, keeping the economy afloat without letting inflation spiral out of control. The next few months will be critical, as any misstep could lead to either runaway inflation or a prolonged recession. The Federal Reserve's recent half-point rate cut isn't just a simple adjustment. It's a bold and risky move that reflects deeper economic concerns. As we navigate this financially turbulent period, the Fed's actions and the market's response will be crucial in determining whether we can achieve a soft landing or face a harder economic fallout. Powell and the Fed have a delicate balancing act ahead, and every rate cut from here on will carry significant implications for the economy, the markets, and your personal finances. If you found this analysis insightful, please like the video, subscribe to the channel, and hit the notification bell so you never miss an update. Your support means a lot, and thanks so much for watching. We'll see you in the next one.